For our COBT viewers and listeners, it's Maynard Mike and Jeff Tillery with a great discussion just in time for NAPE with David Batt. He's the president of Kimberlite Research. Now, I say just in time for NAPE. NAPE, as you know, is all about oil and gas, the North American Petroleum Expo. It's a massive trade and strategy show for oil and gas producers. But they are the number one customer base, if you will, of oilfield service companies. And Kimberlite Research, if you don't know them, they do an extensive analysis based on surveys and all kinds of data of all the companies out there providing services to energy companies. It's an amazing compilation. David's been at it for a while. He's got some latest work he's going to review with us. But David, let me just pause and say thank you so much for joining. It's always fascinating to spend time with you and talk about your world.
Thanks, Maynard. Glad to be here with you today.
All right. Well, Mike, the markets are pretty boring. There's just nothing going on the screen. I just don't even check it. It's so tepid and uneventful these days. Anything you'd share with us?
Yeah,
before we
Maynard.
jump in?
Maynard. I typically open up with 2 or 3 minutes of dialogue. It feels like with Trump in office that it's going to have to be a 15-minute show going forward because it's just at light speed, quantum speed with stuff that's coming out on a daily basis. But one of the things that typically when we do this, sometimes we do it before the market closes on Tuesday, and with Trump in office, half an hour before the market closes, who knows what's going to happen? So stuff that you say right now might be, might be gone by this afternoon. But anyways, the things the market are really trying to get a handle on is, like we said, Trump. It seems like every day something else is coming out. Last week we had the DeepSeek news for markets, and then this week it's been about tariffs, and who knows what next week's going to bring. And so I think the markets are on edge, it seems like, on a daily and even an hourly basis. And so I don't think that's going to change anytime soon. As far as the bond market goes, the bond market's been stuck at roughly 4.5% yield, a 10-year bond. And, what we've said before is that everything seems to be, moving away from what economic reports are saying and more what Trump policies are going to mean, for the U.S. And so that's kind of unsettling a little bit for the bond markets, but it is what it is. As far as the S&P, like I said, this week it's all about tariffs. Who knows what next week's going to be all about? I think from a crude oil standpoint, crude oil's been stuck in the $72, $73 barrel range. I think most people think that the markets are going to be oversupplied in the first half of 2025. If you look at WTI time spreads, that's not what it's signaling right now. It's signaling a physically stronger market. We saw last week OPEC decided to keep their, the curtailments in check. They're looking to bring those barrels back in April, and so that looks like they're going ahead according to plan there. I think today what's affected the crude oil markets. Crude oil was down about $2 this morning. Now it's up probably 30 or 40 cents because it seems, or the news is Trump is now going to basically go after Iran. He's looking to reimpose sanctions, and if you just get an idea of what exports were under Trump, they went down about 1 million barrels when he put sanctions on. They're up about 1 million barrels since he's left office. So you're probably dealing with anywhere from 0 to 1 million barrels a day of sanction potential, which is obviously going to lift crude oil, and also provides OPEC some room in April to start bringing back barrels if those policies really tighten up the market. As far as equities, broader equities, energy equities go, the last week and a half has been about the big three: Baker, Halliburton, and Schlumberger, SLB if you want to call it that. What we've seen is guidance for those guys, North American guidance, and we'll talk about it a little bit with David here, is North American guidance growth has been about, anywhere from, flattish to down 4 or 5%. International, most of the guidance has been flattish for 2025 with big declines in Saudi and in Mexico. In this week and last week, it's about oil majors. Most of those guys, pretty good results. It's all about return of capital, very modest growth for those companies. Today, you had MPC report. Last week, we had Valero and PSX, 3 of the biggest refiners in the U.S., and they're talking about second half 25 refining fundamentals globally looking to get better because they're seeing basically capacity coming off the market. We haven't seen that in a while, so I think those stocks are really starting to react to that. And I think in the next couple of weeks, we're going to see a lot of the E&Ps, large cap E&Ps, are going to start to report. We're going to finally see their CapEx plans. This is going to probably feed into what David's going to talk to about today, but it's looking like that's going to be flattish and maybe up slightly, if that. And so I think that's what we're looking at right now for the energy markets. And, like I said, it's going to be an interesting couple weeks, couple months, couple years with Trump in office, and we're looking forward to it.
Awesome. Well, let's just go ahead and jump in. David, what you do is it's really unique. I'm not sure I can think of another company that that's organized and constructed in quite the way yours is. I know you've got a couple slides you might show us here, but maybe we just start there, just orienting the audience to Kimberlite and how you guys approach things, because it is really different.
Sure, Maynard. Yes, I'd be glad to do that. Each year we personally interview through one-on-one phone interviews, Maynard and Mike, about 3,000 E&P operators and users of oilfield services globally. About half of our research is North America, half international. And as we talk to the drilling engineers, completion engineers, production engineers, and so forth, we cover the swath of the oil field, basically capturing their feedback about future activity and trends, technology use, technology adoption, their experiences with technologies, which technologies they plan to make greater use of, and where the technologies need to be improved, as well as just kind of an objective benchmarking with respect to supplier performance of the oilfield service companies as to whether or not we're getting better or not, and how did the various suppliers kind of stack up vis-a-vis one another.
Just one mechanical question. So 3,000 interviews. You just think about the people hours that have to go into all that. How do you get people to spend that much time with you? How much time do you spend with each person? Like how has that process evolved over time? And why are they so willing to spend that time with you? That's sort of a basic question.
Great question. We personally at Kimberlite, Maynard, we burn about 20,000 hours of calories every single year just to call, talk, network, and qualify the folks that we're talking to, right? And when we publish these industry reports, we send out report summaries back to all the E&P operators that participate in the research. So we serve as basically a 360-degree feedback loop back to the industry. So it helps E&P operators benchmark. For example, if a particular technology adoption rate is starting to increase, like self-oriented perforating guns, but yet they don't use self-oriented perforating guns, it's kind of a wake-up call for them to say, hey, this is growing. Maybe I should look into this. What's the benefits of this? Am I missing out on something, right? And so, our research is used also by obviously the investor community as well as the oilfield service community. Just to kind of, everyone has to benchmark and be very pragmatic in their allocation of resources, both the E&P operators and the service providers. So this just helps the industry help benchmark.
And one question for you, David, when we talk about the oilfield service community, like I assume your definition of that has expanded greatly over time. Right. Like how give us a full sense of the complete menu, if you will, when you talk about providing feedback on the OFS industry?
Well, when we talk to the drilling engineers or the production engineers or completion or subsea or geologists like myself, right? You talk about that?
Well, I just mean all the different lines of business that you are doing evaluations on, like, from equipment to service to technologies. Like it's a real broad range of things, and I assume it's been growing over time.
It has. We cover a lot of the major oilfield services that are used most often, like drill bits and directional drilling services and rotary steerables. Many of these products and services move at a very high velocity. They're updated annually. We do about 20 proprietary custom bespoke reports each year for clients as well. Others move a little bit slower, like subsea equipment versus subsea services. We alternate those years. But we cover the broadest swath, if you will, of the most commonly used oilfield services across the industry. We also, not pictured here, do pipeline integrity and pipeline inline inspection research reports. It's not pictured here, and that comes out here actually just in a few months.
Well, and you also you get involved with digitalization and
Oh, yeah.
software applications and all that. I think that is kind of surprising from your base description there.
Well, what happens is we commonly get a call. Do you have a digital report on what? Everything. And we go, okay. So it's hard to boil the ocean all at one time, right? So what we do is when we talk to the drilling engineers or the geologists or the subsea completion or production engineers for each one of these product line centric reports, we'll ask them about their future needs and trends and experiences for digital, right? And that allows us to start to benchmark which areas is digital contributing most to. Like as a geologist, for example, I'm really into machine learning as it relates to seismic data processing and subsurface interpretation. But as an earth scientist, we made up a very small portion of the overall digital requirements of the broader industry of how do we drill better wells, complete better wells, produce better wells.
So it seems like, David, I know Jeff and Mike will jump in, but the story in OFS, it seems like over the last few years has been efficiency and just being able to do more and more. So it's kind of technology, kind of cost management, but correct me if I'm wrong, and also you tell us how you think about the key trends in the last 2 or 3 years.
Sure, I can share a few slides too, really quick. I mean, obviously, as Mike mentioned, the gross international and offshore in North America is flat to down. But when you pierce in more deeply by subsectors, the bottom right subsea deep water sector, Maynard, is really where most of the growth is for 25. I mean, you still have to wait nearly 2 years to get a subsea tree, for example, and supply chains still remain tight for qualified equipment and people. Production space tends to be the most resilient globally, even in North America. Land drilling and completions tends to be a little bit more, centered towards international offshore. One of the things that people ask is, why aren't we drilling more wells? And as you just pointed out, we don't need to be drilling more wells. We're producing historic levels of high oil and gas volumes at very low activity. And it's all because of this series of drilling, completion, production technologies and efficiencies that are just been stacking on one another. It's not any singular technology that's making a difference. And sometimes people always ask, what's the one technology that's making all the difference, right? And there's no singular one. It's a lot of really smart, hardworking, innovative folks and companies out there, Maynard, making it all happen.
When you think about your top 2 or 3 technological innovations of the last year or so, which ones jump out at you, David?
Oh, wow.
You got to pick your 3 favorite. That's unfair. It's like Sophie's Choice here.
Well, I mean, clearly rotary steerables is a big one for drilling. Imagine if you can drill a curved lateral, Maynard, all in a single run, right? So you drill 300 wells a year and you can drill a curved lateral. Hypothetically, you'd save 600 drilling days. That's like getting 60 free wells without adding $1 additional of CapEx, right? So that's clearly a big one. I think self-oriented perforating guns is having a material impact on our ability to produce more per frac stage for perforation. As you know, we always drilled these longer laterals and we always used to say, yes, but 10, 20, 30% of the frac stages really were not materially contributing to the productivity of the wellbore. And so I think something as benign as that is fairly material. The reliability of ESPs just continues to get stronger and stronger. The software and the digital aspect of it, being able to monitor and optimize, all those are playing significant inputs.
What are you seeing, David, in frac technology? You mentioned the self-oriented perf guns, but what else is going on in completions that strikes you?
Well, there's some, obviously completion efficiency is number one. Well, I guess I should have put this. Could I go back and add this to like my top 3, Maynard? But
Hey, David, you're the guest. You absolutely can. We'll ask you for your top 4.
Okay, thank you. Because this one probably needs to roll in there. You can see that the adoption of simultaneous dual fracturing, if you will, is on the increase here, right? And it yields tremendous efficiencies of 35%. The problem has always been, how do you pack enough horsepower on a small footprint? And that's been tied into, as we retire the conventional diesels and invest more in Tier 4 dual fuel in electric, we're able to pack more horsepower on a smaller footprint, right? So you can see how all of this is beginning to connect, if you will. I've talked about the adoption rates of self-oriented perforating guns. And so usually if something works, the word gets around and you see rapid adoption rates. And this is pretty rapid adoption right here. So if you're an E&P operator and you're not using this, and you notice that your peers in the industry are, you have to ask the question, why not, right? And you need to, conduct some due diligence, because we're blessed with so many choices out there in the marketplace. But this one's a beautiful one. You reach maximum frac pressure more quickly. You don't get the high horsepower charge. The pressure pumpers don't have to wear out their equipment. Less water, less chemicals, improved productivity. We just did a study on CNG and frac power. Obviously, the E&P operators, they want to use their field gas for the economics of it all. But realistically, Maynard, they have trouble doing it. Some of the field gas is so bad that they have to use CNG and LNG. So you're going to see a lot more investment by the pressure pumpers on gas conditioning capabilities to try to help use as much field gas as possible to displace the purchasing of CNG and LNG, right? These are just some of the things we track. Obviously, there's a big range in gas substitution rates, and it's really the hydraulic fracturing pressure pumper coupled with their experienced personnel and good gas conditioning that helps to make this work. Electric's really big, but a lot of these electric fleets are being powered by CNG, LNG, even though they would like to be using field gas 90% of the time, right? Grid power is not there yet. We only power a little bit from the grid and not much expected from the grid 3 years from now. Recips are viewed as more efficient and lower emissions. So you'll probably see the recips begin to grow in the future, but turbines are more available today in the short term on the supply chain. So you see a lot more turbines, particularly in the mobile power applications, just due to supply chain availability. So there's a whole host of things that we're tracking here. Electric does have its challenges. The turbines don't perform well in extreme weather conditions. There's a lot to get familiar with. It's new. That's why dual fuel tends to be a little bit more preferred than electric. And digitally, obviously the E&P operators, particularly the large operators, they place a lot of value on their pressure pumper that they select for having all types of digital capabilities. And so you'll continue to see material investment, at least by the big four, to further advance their digital capabilities.
That comment you made, David, about people would love to use their field gas more, but there's some challenges there, and they end up using CNG and LNG. If I wanted to use more of my field gas, who would you mentioned, conditioning or otherwise just kind of cleaning up that gas to make it easier to use. Do you give recommendations to people on who they should call for help with something like that?
Well, our reports do reveal suppliers that are used and how the various suppliers perform. So we do help oil companies, if you will, and their supply chain strategies, try to pick best-in-class providers. But one of the things that we learned in the report from the operator's perspective is, think of this as a great big orchestra, and you've got the conductor, and the conductor has to have all the various contributors participate and contribute. There's a lot more incentive if the pressure pumper is able to control as much of the activity around that frac site. If you hire a third-party conditioner of the field gas, oftentimes you lose accountability, right? Whereas if you tie everything around your pressure pumper, you can hold that singular provider accountable. There's an incentive for them to drive gas substitution to the highest level so that the pressure pumper can demonstrate to the E&P operator the value that they created, right? Does that make sense?
Yeah.
And obviously at the end of the day, the E&P operator is looking for completion efficiency, number one, maximum gas substitution, number two, fuel efficiency, right? And it's all about efficiencies and economics.
So, David, do you do that kind of example I was just giving? I'm not clear if that's how an operator, how an E&P company might use you, but do you get those companies calling you saying, almost like, who do you recommend for the following service, or do you try not to go there? You just say, well, look, this is the data. Like, how much of a service do you offer when people are curious like that?
Well, we're a consulting firm. It's all predicated on the voice of customer research. We don't necessarily say, I, David Batt, provide a recommendation for one supplier over another. The voice of customer feedback and the independent objective benchmarking speak for themselves. So if you're a traditional E&P operator, say you're trying to expand from two mud motor suppliers to a third mud motor supplier, but you have over 30 directional drilling options. How do you screen down to what are the one or the two or the three directional drillers that you should look at? Because it takes time and money for the E&P operator to invest due diligence time to go look at the quality processes and the remanufacturing processes of their suppliers. And so they use basically our research as a screening tool, Maynard, to say, look, I've got 30, 40 options, so I'm blessed. I don't have time to do due diligence on all 30 or 40. Who screens out to be the top 3 or 5? And then from there, they'll usually take it from there.
Do you notice in these reports, and remind us again how long you've been at this?
I've been doing voice of customer research, I think, for about 15 years, 14, 15 years.
Okay, so in that period, are you able to tell how sticky the relationships are between the customer and the service providers, and whether or not are we going up? People are tending to stay more with who they've had, or are we in a period where people are, experimenting more and switching? What would you say about that?
Well, we track many things on the performance parameters. And one of the things we do track is the Net Promoter Score, how likely you would be to be recommended. And when we run some statistical correlations as to what are the key drivers as to why an E&P operator recommends an oilfield service supplier, we'll find that there's 3 key drivers. It's, price, availability is one driver, maybe differentiated, consistent service quality is a second, and then differentiated technology of performance is a third. And North America land has such a broad dichotomy of operators, like at the NAPE show this week, right? Where you've got small independents, medium-sized independents, large independents, you've got major oil companies, and they have different drivers, right? And so you'll find in North America, approximately a third of the market to be very relationship price driven, about a third driven by service quality, and a third driven by technology and differentiating performance. Whereas when you move internationally and offshore, it really starts to disproportionately shift in the eyes of the users of these services and technologies and the E&P operators around performance and technology, particularly internationally, because they yearn for access to some of these great technologies. We're blessed here in Houston in the United States. A lot of these innovative companies are right here in our backyard, all right? But when you're, as you know, oil and gas operations taking place in well over 100 countries around the world, and they're hard to get to. And sometimes it's hard to get some of these latest technologies out there.
Hey, David, maybe some thoughts about, last year's observation conclusions in your report and maybe this year. Where were the major differences? And the reason I ask that is, we have a lot of companies that we talk to, and if I would have said a year ago that, hey, I think that, this efficiency, productivity was probably 6th or 7th inning, I probably would say it's probably there again this year, and a lot has happened. So maybe talk to us a little bit about the efficiency, maybe the attrition of the frac fleet, stuff of that nature, that, if you sit there and talk about it next year, what are maybe some observations that you're seeing this year, and where are the observations going to be next year in that business? Or do we see a fleet that's been really run hard, that attrition is going to be a bigger issue next year? Or how do you see those things?
Well, we've been tracking these efficiencies for a number of years. And when we first started tracking it, Mike, it was just like you said, well, certainly there's going to be the point of diminishing returns, right? And people always used to ask me when that's going to occur. And last year was a really tough year for many to reconcile. Rigs were declining. We're drilling, fewer wells, production sticky, resilient, and growing, and it just kind of defies the odds. And what I learned about 3 or 4 years ago is I'm not able to necessarily predict what that next best mousetrap is. Okay. And as I go through all the drilling technologies, completion and production technologies, it's very clear to me that there's no singular technology that's working on it. You've got HFTO, you've got telemetry improvements, you've got drill bit improvements. Remember, you pull the drill bit out of the hole and you look at it, you go, I think that drill bit's wore out. Well, today, they're using, scanning and machine learning. And the other thing that they're doing is they're taking everything that they learned when they pull that drill bit out or that ESP out, and they tear it down and they look at it, and they use that to design an improvement in the design of the equipment. And that's something that a third-party pure play software provider, say out of Silicon Valley, doesn't have that equipment knowledge. They can't get that full closed loop circle that the oilfield service companies can. And so you're finding that the major OFS suppliers that have the balance sheets and the means to invest digitally for that next generation technology, continuing to up the curve. And I'm no longer going to ever predict when that ends, because the innovation and the hard work, grit, and tenacity of this industry just continues to prove itself year in and year out. Now, the thing that's frustrating for so many is you go, well, we're accomplishing so much more with less. We don't need to drill as many wells. CapEx, we're not spending as much CapEx. As you pointed out, market looks a little bit oversupplied in the front half, and we have to be disciplined to make sure that we're not adding supply at a rate to the market that's faster than the growth in demand, right? And we have to maintain some type of stability and healthy market. Obviously, OPEC's been that throttle for the last year or two. But geopolitically, it'll probably open up, as you mentioned with Iran, open up some windows for OPEC or Saudi to gracefully re-enter the market while maintaining a nice, healthy, stable market.
David, great to have you on. The data and the questions you answer in your materials are so robust. It's, so much of the oilfield services research through time is pretty generic. So one, just a compliment to what you put out. But I was curious, just from a process standpoint. I don't want you to share too much, but how do you get comfortable you're getting the questions and insights to the right person at the customer to really draw out the right insights? And I think about it particularly, here in North America, as the business has consolidated a fair amount. Now we have some really big companies operating such big chunks of the oil field activity. How do you get the questions to the right person?
Well, I pointed out earlier, we burn about 20,000 hours of calories. I wish there was a faster way to make the gumbo, so to speak, but it's we spend 20,000 hours each year just to walk away and engage in 3,000 meaningful conversations with users of these services around the world. And so it's very labor intensive. And I know we're, just a small boutique niche research consulting type firm. And I'm wondering, some people say, well, why isn't there someone else that does what you do? And I'm not really sure there's anybody else dumb enough to do what we're doing. I mean, who else would spend this much time trying to reach out and qualify and talk to the right people? Seriously, I mean, it's a very painful, laborious task. The part that brings us a little bit of joy is I get to come to work every day and learn something new. And I get to aggregate the data and benchmark it and send it back out almost in a 360-degree feedback loop. And we get to collaborate with some of the brightest SMEs that these oil companies, E&P operators, who are looking to drive efficiencies to the next level, as well as with some of the brightest SMEs at oilfield service providers that are trying to further improve their product offering, their mousetrap, right? Everyone's trying to get better. And it's just this beautiful desire to want to keep driving the industry forward. And now it's a lot different when we interface with oil companies internationally. They're different pace. and different curiosity to learn at times, right? But the curiosity to learn is extremely high in North America.
I was going to follow on with that. The path for seeing improved efficiency in oilfield services in North America is pretty well trodden. As you think about the next 2 or 3 years, whether it be Middle East international land or subsea, what do you see the biggest opportunities for the business to get more efficient and more profitable? What are those target areas?
Well, both deep water, obviously long cycle barrels, but you're also starting to see the unconventional trends as they expand to the Middle East and obviously continue to expand in Latin America. I mean, so I came out back here in the days where you could add 1,000 or 2,000 drilling rigs and very little response to production. And so, all throughout the 80s as a geologist working for a major oil company, we were just facing this trend down going, oh my gosh, did I pick the right career? I mean, if I keep drawing this line by 2030, 2035, we're going to be plumb out of oil. And so what's happened here is really just the unthinkable. And so this desire, the downturn of 2015 was so stark and so drastic, we had our backs up against the wall as an industry here, if you recall. I mean, we're going to drive out the unconventional. And now that we know that unconventional is a very viable, short cycle barrel so it can respond, I think you're going to see that globally there's a lot of unconventional potential out there. And you're going to see a lot of people wanting to translate the success that we've demonstrated here in the US market or the North America market to the Middle East and translate that more internationally. So the two areas that I really see a lot of growth in is unconventional globally. I mean, you actually have some frac spreads in Australia right now, right? Obviously, China and other areas are looking into unconventionals as well. And these are all very service intensive formations and wells to be drilled. So this gives a favorable backdrop for OFS. If you're looking for some type of catalyst, if you will, long term for the OFS market, that's one of them. Deep water is much smaller today, but boy, you look at those huge finds in Suriname and Guyana, and you begin to realize that these deep water elephant fields are certainly going to be an area where you're going to continue to see more efficiencies invested.
David, would you mind talking a little bit more about the international unconventional? It is really interesting, and there's the Argentina's got a lot going on. You mentioned Australia. Are there any other areas you'd mention? And it seems like international unconventional sort of swings in and out of vogue a little bit. Like sometimes we're hot on it, and others other times less. What would you? I think it's a great topic to spend a little more time on.
The reason why we're so successful here in the U.S., we obviously, it's very fast paced. We learn fast, we fail fast, right? And in order to run, basically, it's a manufacturing process. And so you've got to have all these logistics intact, okay? And that's hard to do. And so as you move around internationally, Maynard, I mean, you certainly have some constrictions, if you will, about the ability to move at the same velocity that we do here in North America, okay? And that's really going to be the constraint, not to mention just the cultural differences and the speed at which they make decisions. I mean, keeping, 80% of the time, we're adjusting the frac job in real time, right? It's not like we put together, like when I came out in the 80s, it's like, gee, we're going to go drill X number of wells and we planned. Well, today, I mean, we're drilling so many wells so quickly, everyone's audibilizing at the line of scrimmage now at the Super Bowls this weekend. Just imagine you show up for work and every day you're audibilizing at the line of scrimmage. It's not like a really deep water well that you plan way in advance. You pretty well execute and drill to the path on the wall. Okay. Here you're audibilizing the slide rotates sequences. You're monitoring where you are to stay in zone. You're hydraulically fracturing the well, and based on the reservoir response and the downhole response, it's very much a dynamic process. To fully translate this internationally requires a whole host of logistical issues and supply chain issues that are not necessarily always present. Okay. And so that's why, I do see the growth internationally. The pace of growth and adoption, will vary depending upon each country's ability to put in place these factors that are necessary to bring success to such a high velocity operation.
Well, and you don't have to give away any secrets, but are there other places around the world do you think people should have on their radar besides Australia and Argentina, which have been, a little more notable of late?
Well, I personally think that the Middle East is probably going to be one of the more stable growth areas for unconventional, just because their supply chains are developing. When you look at the Middle East, 80% of the market share for many of these product lines and services are held in the hands of the big four, right? Whereas if you come to the United States, it's just the reverse. 75% of the market share is held in the hands of these smaller specialty providers. And so you've got more and more specialty providers moving towards the Middle East, expanding the supply chains. And that's the next big epicenter, if you will, in terms of where you've got enough scale to drive this. You have to have scale. When you move into these remote areas, more remote areas around the world, it's just hard to get the scale that you need to achieve the level of outcome that we're seeing here in the U.S.
So, David, you mentioned that a lot of people call you. The service companies want to know how they're doing. The E&P companies. You mentioned investors. I assume that's public and private and all different types. Are there other people showing up who want to hear your views that would surprise us, like power companies, tech companies? Like, are there other folks that are calling that you're like, wow, this is new but kind of fun?
There's a lot on the digital front. We get a lot of tech outreach, right? Do you have a digital report for this or a digital report for that? Of the bespoke studies that we do, they're kind of mixed. There's M&A, right? You signed an understanding, the MOU or LOI, and you're within a 45, 60-day window to transact. And oftentimes we'll do due diligence on the target company. We'll do a lot on new technology. I can't tell you how many times someone came up with a great new idea saying we're going to build it and they will come. They built it and they didn't come. And then so we have to go back and unravel what went wrong with this, right? Going back to what is the market need? What are the market requirements? Remember, E&P operators and the strive for efficiency is such that folks are looking for the best route. And so and then there's just basic, how are we doing with our customers? You really have a lot of oilfield service providers that are just looking for some type of independent benchmarking of how are we performing. We think we're doing a good job, but how do I independently document that?
So David, this is kind of a cheeky question, but I'll ask anyway, which is, whenever anybody develops a survey that's going to determine who's ranked the best, somebody somewhere says, wow, how do we influence that survey? So how do you, everybody cares about how they're ranked in your survey. How do you, kind of prevent, if you will, people from, sending donuts to the person who's about to field a call from you,
right,
and try to influence the election?
Well, we have means and mechanisms. Obviously, our research staff, they don't really know, where the contacts came from, if they were provided by oilfield service company A or B. We get contributions from everyone, of course, but as we spend 20,000 hours talking and networking, we're getting repointed, right? And our collaborations with the E&P operators gives us access to their SMEs as we need them, okay? Occasionally, like we just finished a project recently with one of the smaller oilfield service providers, where they use our industry report and they go, well, gee, this is really nice, but you didn't get my 5 or 10 top customers or my cherry customers. And so, they'll hire us on a bespoke study, Maynard, to go out and append the data set with, quote, their top customers and re-benchmark. And sometimes you'd be surprised how much or how little it really moves the needle, right? It's what I find is most typically you're either systematically performing well or not performing well. And we look at the dispersion of performance, right? And so, yes, there's always an isolated incident where a job didn't go well here or there. And those happen, in the oil field. If they don't, you're probably not in the oil field services business. But operators are looking for a consistency of performance. And so it's really the oil field service providers, while they'd like to always get a nice report out, if you will, the data is what the data is. And even though they would love to be able to influence, they're just not able to do it. I mean, at the end of the day, their performance track record is their performance track record in the eyes of the end users.
I thought it was interesting. A lot of your plots and graphs and the analytics that you've shared with us it will illustrate, a comparison. And the thing that's striking about the top companies is that, their top performance is similar to many other companies, but they just have their top performance is 90% of the time. That's how they perform. They have less variability in how they perform. Would you mind elaborating on those types of data maps that you've surfaced?
Sure. I probably have a value map in here somewhere that's generic, but typically on our value map, if you're familiar with what that looks like, we have performance on the x-axis and pricing here. We commonly see differentiated markets, premium providers cost more to be worth it, or discount provider, but everyone's delivering fair value. What the E&P operators are interested in is consistency. They're looking for dispersion, right? So if you're going to do whatever, 1,000 jobs or 100 jobs this year, what's that dispersion of performance? What you're trying to avoid is a very broad dispersion that lends itself to the observation that as an oilfield service provider, your consistency is not there from job to job. And we all know how that can happen. It can be due to equipment. Like I have some old equipment, I have some new equipment, right? It could be due to crew competencies. You happen to get the good drilling rig with the good crew. And poor, Mike got the bad drilling rig with the bad crew, right? And so you saw dramatically different drilling efficiencies take place. All right. Same thing with the cementing crew or hydraulic fracturing crew and so forth. And so consistency of execution is absolutely key. And that's one of the things that we track. In addition to just, is the industry getting better or worse? Like in 2022, for example, responsive to customer needs and obviously availability of qualified equipment and personnel, all the ratings declined in U.S. land. We're in over our skis, if you recall. We all came to work thinking, gee, we're going to drill 15, 20% more wells, and we ended up drilling close to double that due to the war in Ukraine and the need for oil, right? And the private stepped up. And so we're tracking these trends, and obviously this gets back into, for the E&P operator, supply chain strategies. How do I deal with this, right? How do I augment for where we've got these gaps? If the oilfield service providers are strapped in a particular area of performance, we as a good partner, because we want to yield a good outcome, right? How do we fill that gap and help cover this period of time where everyone's stretched out over their skis?
Hey, David, I'm going to probably just switch over to AI. I know we haven't talked about it enough yet, but when I kind of look at the AI market and how it's affected equities, I kind of look at 2022, 2023. We kind of heard about AI, but really 24 was more about implementation and just the companies that are benefiting, be the IPP companies through electricity, big tech, et cetera, et cetera. I guess my question would be is, how are you asking those questions of the people that you sample? What are some of the feedback they're giving you? And maybe kind of where are they on this whole AI revolution? Are they in the first inning? Are they further along? Just some thoughts on that.
It's the very beginning. Remember how Maynard or Mike, I told you sometimes we get asked, do you have a digital report? And we go, on what? They go, everything. And we go, okay. I want to hear from the geologists. I want to hear from the drilling engineers, the production engineers, the subsea engineers, the completion engineers. And so as you can see, for the most part, on the left-hand side, you have, it's almost 40, 50% of the operators are saying, yes, the use of AI and machine learning moving forward is going to have a material impact in my business. I'm going to use it. when we ask open-ended questions about where do you see the greatest view in machine learning and AI, it's production optimization themes tend to resonate to the top. We don't really think about this so much in traditional oilfield services, and I guess I forgot to mention this, Maynard, but there's a lot of what we call NDT or non-destructive testing and integrity. So you have all these fixed and rotating assets scattered around the world, be it an offshore platform with rotating equipment on the surface or risers and so forth. You have to monitor the condition and the integrity of all these assets, from corrosion growth assessment to cracking to you name it. And so integrity assessment is really big. All right. And then from there, obviously drilling, if you're a drilling engineer, everything revolves around drilling. And obviously, if you're a geologist or geophysicist, everything revolves around modeling and simulations. But when you put this into the big scheme of things across the oil and gas industry, this is how it stacks out. The irony is when COVID hit, everyone went to remote ops because we had trouble logistically, but then people began to realize that the big benefit of remote ops wasn't necessarily fewer personnel on the well site, which it is a benefit, don't get me wrong. We're just making better decisions, right? So now you've got SMEs sitting in a remote operations center watching 2 or 3 or 4 frac jobs at the same time, while you still maybe have boots on the ground, right? And so now you've got more expertise, and now you add the benefit of the algorithms and the AI ML, all of a sudden the velocity at which you're able to make better informed decisions is tremendous, and it just saves time, it saves money, drives efficiency, and everyone feels like they're making better business decisions, better decisions on how to produce the well, how to drill the well. It's interesting. Just take something as simple as an electric submersible pump. I mean, most E&P operators are sitting down with their ESP providers, and they're looking at the run data every week, trying to figure out how to optimize the operability of that ESP. Should I put this ESP in gas mode, or should I put it in maximum production mode? It's like your car. You're going to press the economy button, the sport button. I mean, these are not your father's ESPs. I mean, is something as benign as that, or even these drilling advisory systems providing guidance on slide rotate sequences. I mean, you're skidding over, you practically digitally twinned a well already before you drilled it. And so you have a lot to anticipate and what to expect. And so we just continue to see all of this digital investment. The beautiful part, again, as I mentioned earlier, is the E&P operators think that these third-party software suppliers are more digitally agile in building predictive platforms. Here, I'll show you the slide. It was a really cool slide. The E&P operators are saying, well, the third-party software providers are really best at developing the digital platforms and the predictive analytics tools because, gosh, these pressure pumpers are just dumb iron guys, right? They certainly can't be as digitally agile as those, whiz-bang developers. But these whiz-bang developers, they're not able to understand the equipment and close the full loop circle, right? And that's really where the oilfield service providers, I don't care if it's the pressure pumpers or it's the key directional drillers or the key artificial lift providers, okay? The other thing too that we've noticed on the production front is when things go wrong, they go wrong. And usually it's either a chemical failure or a mechanical failure. And you have to be able to understand the linkages. If you take a chemical pump and it lasts greater than 24 months before failure, you're going to extend the runtime of your ESP and gas lift systems by 20+%. So there's a desire to figure out how do you extend the life of these chemical pumps. Imagine you're in the hospital on IV and the IV pump kicks off, and all of a sudden, the whole reason why this well's on a pump to begin with is it needs that proper dosage on a regular frequency. You turn that off, and all of a sudden, the well goes into distress, right? And so you're starting to see a lot of linkages to where you really need to have the scale and the scope to be able to invest in these next generation technologies. In our research at Kimberlite, we have feedback on well over 1,000 oilfield service providers. We don't really need 1,000 oilfield service providers to meet the needs of the E&P operators because it's a consolidating market and we're driving efficiencies, right? On the mobile power thing, I'm glad to see oilfield service companies looking for growth opportunities and moving into mobile power. I think that's cool. I think some of these are natural adjacencies, right? Because if you're a pressure pumper and you go into mobile power, you're vertically integrated. So you've got your core business to support, and that's pretty cool. And in other cases, they're moving to non-oil and gas sectors. And that really comes down to the quality and the duration of the contracts, how good of a counterparty have they signed with. But we all know that when you drill and produce a well, it could take you, several months to connect to the grid. And so there's always going to be a need for mobile power just to be able to provide the juice that we need to run the operations that we're doing today, just in the oil and gas sector. And then obviously the non-oil and gas sector, if they're good, strong counterparties, like some of them have reported out, XAI and others, you go, well, that's a pretty solid counterparty. What was the duration of that agreement? 2 years, 3 years, 4 years. And so I don't think the mobile power is going to end up being stranded assets just because the grid is in such a condition that it just takes a while to get connected to the grid. There's always going to be a need for mobile power.
Just one follow up on that, David. I mean, we talked about AI for some of your clients, but what about you? How are you're aggregating all this data? It sounds like something that AI would be really good at doing. Are you using that right now? And where do you think you'll be in, say, the next 12, 24 months for your company?
Right. We have a very robust online platform that I didn't demonstrate here today. I'd be glad to share it with you. But we're continuing advancing our algorithms, just like the algorithms, how we were able to run correlations, the likelihood to recommend a supplier to kind of tease out which markets tend to be more price commodity driven versus more technology performance driven. And so we continue to use, algorithms and AI, machine learning type capabilities. We're a small company relative to some of the larger consultancy firms, Mike. So, our journey of learning in this space is just one that just will continue. I guess you could say we just threw the first pitch. We're so early in the game, right? So this digital journey is going to be a beautiful one.
David, so much of the work is really insightful. So I felt obligated to ask one controversial question. Just as I look through the materials, something that either surprises me or doesn't jive with how I've perceived the buying pattern. And it's really you've got the discussion around customer buying behavior. In the North American land makes sense where price, technology, and service are pretty balanced. Technology as being the overwhelming driver of decision making internationally and offshore, and pricing being a small factor. How does that jive with the buying pattern of NOCs, where if you're a qualified bidder,
right,
a mandate, low price has to win in many of these instances?
That's a great question. Thanks for bringing it up. In the eyes of procurement, it's 100% price driven. I've never met a procurement department. We interface with many where the decision's not 100% price driven, right? Usually when we get called in, let me see if I can find the slide here. If you're an E&P operator, do you need a premium supplier or discount or value advantage or what? Procurement's 100% price. Usually when we meet with procurement, they know the vertical y-axis. They're here to talk about the x-axis because they know there's differences in performance and there's different performance dispersion profiles. They just don't know, right? And in many cases, they don't know because this is a new area. They've never used these suppliers before. They don't know how they benchmark or screen. In other areas, the procurement departments and the operations departments of the E&P operators may not collaborate as strongly as one might imagine, right? A lot of the users and practitioners of these services, they know what they want to use and why they want to know it. And then you've got the procurement department trying to add value in the administration of these contracts. And one of the ways that they demonstrate value is by somehow trying to figure out how to drive costs down, right? As if everyone's the same Johnny Red Apple. There's no evidence whatsoever in any of our data that we do that all the suppliers perform at the same level. In fact, it's a very significant variance in performance levels. And so if you're not careful, if you're penny wise and pound foolish and you go for the lowest price every single time, about proper due diligence. And in the international sector, they try to get everybody qualified to a certain level of competency, and you know how that works.
Sure.
But if all you're chasing is low price, there's a good possibility you're going to really be shortchanging the outcome for your particular company. Okay. for anyone that doesn't believe that technology and performance, even if everyone gave the same price, it's just impractical to think that everyone's crews are going to be performing at the same level. There's different competency levels, there's different recruitment and training levels, there's different scale levels, right? And so we see the variability based on the voice of the operator and the feedback that we get.
David, I was curious, one of the things you talk about in your reports are culture. And I know that means a lot of things to a lot of people, but is it, I think there's a bias we all have to believe that the companies with good cultures, and I'll define it as strong customer orientation and good employee morale, those types of companies, you think of them as winning in whatever service industry they're a part of, and you think of them as being rewarded in the stock market as well. And I assume that might be the kind of question an investor is asking you. But what would you tell us about those aspects, culture, employee morale, sort of how you discern the esprit de corps and approach of a company and how it tends to rank in your surveys?
It's a good observation, Maynard. And leadership and culture are important. And oftentimes people go, well, what's the secret in their sauce? And you go, well, they have a great culture and a great leadership. And sometimes you just get this big stare, like, what is that? Because everyone's just, they're spreadsheeters, right? And they're just trying to see what's going on. They don't understand what happens in a great environment with great leadership and great culture, right? Where good people attract other good people. And they want to go work at those firms, right? And then the other big thing too is not just with the oilfield service company, even the E&P operators, some of them, not all of them, are waking up to the fact that maybe I need to be a good partner. Okay, because it cuts both ways, that relationship, right? And so when I first came out years ago, Maynard, and you may laugh at this, I worked at a big major oil company. I call U-Haul. I called the oilfield service company. They brought me what I wanted. Oilfield service companies today are far more disciplined. They realize they can't be all things to all people, and they're proactively and strategically choosing what to serve, where to serve, and whom to serve, right? And so, being good partners and winning comes down to good strategies and good cultures and good leadership. It takes both. Once you realize that you can't be all things to all people. The beautiful thing in this industry is if you're an E&P operator, you have lots of choice. But with that comes a responsibility to do proper due diligence, to understand the differences and the choices that you do have. Now you flip the coin, and now it's up to the oilfield service companies to get out there and tell their story, to get their resumes out there on the table. And so everyone's got a lot of work to do on both sides. Naturally, we're going to see more consolidation. There needs to be more consolidation. If you just look at the consolidation with the pressure pumpers, where the big four have roughly 70% market share, whereas if you just back up 10 years, it was just the reverse, right? It allows companies with stronger balance sheets to invest in a lot of these next generational technologies. If you're a really small oilfield service company and you don't have the balance sheet strength, the cash flow to upgrade your equipment and technologies, you're basically going to be operating in that really price-sensitive relationship niche of the market, which there is one that exists, right? But long-term, you're going to have, healthy companies on both sides to be able to drive the investments that are needed to drive these technologies.
Maybe one last question, David. There's so much in your analysis and analytics, and you're just sitting on a treasure trove of things that feel like we could keep digging for a whole nother hour. But as you look at this, you've been doing this for 15 years. You've got the latest, your latest thoughts in front of you. As you think about this broad industry 10 years out, what are some observations that you might have on what this industry looks like? I mean, you mentioned consolidation. It seems like we're always talking about consolidation regardless of the topic, but what key features of this industry do you see a decade out?
Well, it's going to be more digitally focused. It's going to be higher margin, lower capex. I mean, those are the themes that you're going to see. I think you're going to continue to see this focus on shareholder return, right? In the news today, drill baby drill. And that's all I heard as I was getting dressed this morning, with the operator saying, no, we can't drill baby drill. You can't add supply faster than the growth in demand. And so you'll see all forms of energy grow as the world's energy needs grow, as we have more AI and more demand. But I don't think you're going to see crazy growth for the sake of growth. I think this whole industry is just getting more advanced and more sophisticated. And you're going to start to see a widening competitive moat, if you will, between those top tier oilfield service companies that have the balance sheets and the ability to invest in future technologies. And then you're going to have those that don't have that ability. And then there's going to be those that benefit, right? Because it trickles down, so to speak. For example, take pressure pumping. Eventually, even the small pressure pumpers will retire their conventional diesel assets and upgrade to dual fuel, right? Some may take years to do it. Obviously, the big four are really far advanced in that, right? They're almost all dual fuel or electric. But some of the small guys may take another 7 or 8 years to get there at the rate that they're moving, okay? Unless they pick up the pace. And so I think the future is really much technology driven.
Do you notice, David, you mentioned returns, and a lot of times that can be driven by public investors. It can happen for a lot of reasons. I'm not saying it's a bad thing at all, but do you notice any differences in the data between public companies and private ones?
Yes, I do. Obviously, the publicly driven companies are far more visible to public scrutiny as to what their returns are, right? Whereas a lot of the private companies, obviously more private, sometimes are much more willing to accept, say, mid-teens returns on EBITDAs, right? Where others are striving for 20% EBITDAs. And so you truly get this dislocation in the market. I'm a small supplier of a lower cost structure. I'm willing to accept, 12, 14% returns from my private company. And it's harder for some of the larger guys with a higher cost structure that have a higher financial threshold to compete. And therefore, you see these dichotomies in bids, right? That's the vertical y-axis on our value map. What about the performance axis, right? So, just take the simple concept of, I want you to pay an extra $20 for a self-oriented perforating gun. That's going to cost you, Maynard, an extra $12,000 on this frac job. But I'm going to save you 10 minutes per pump stage. I'm going to knock off half a day of pump time. What's that worth to you? Well, that more than covered the extra $10,000 in perforating guns, right? And so, this whole total cost of ownership and total value creation needs to be taken into account. All too often, it's not.
Well, David, this has been fascinating. I think we knew coming in we wouldn't be able to complete all the zones of your analysis, but just because there's so much here. But you're a real resource to so many people, and I think that's evident. And we appreciate the friendship and look forward to digging in more with you in the future on a lot of these issues and developments.
Sure. Great to be with you, Maynard, and Mike and Jeff today. We'll do it again one day, maybe.
Well, with the NAPE crowd, hopefully a lot of people see this and say, I think I need to call David and see what he thinks of this or that service.
NAPE's a great show. I'm glad they're in town.
All right. Thank you, David. Thanks, everybody. Talk to you soon.